And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I am your host, Bob Pisani. September is living up to its reputation as a volatile month. ETFs love volatility. It doesn't matter. Risk off, risk on environment. ETFs have solidified themselves as a vehicle of choice to express views. Let's talk about that with Noel Archer. He's the global head of ETFs and investor solutions at AllianceBernstein. And Todd Rosenbluth is the head of research at Verify. Noel, a lot of volatility around tech, and I know you have a very interesting fund, actively managed large cap equity ETF. Big holdings I see here in Microsoft, Nvidia, and Alphabet. This is still where the flows are this year, still in tech. Are we going to continue to see this flows in, tech outperform?
Yeah, look, I think there's obviously a lot of questions which way the market's going to go. I think the numbers on Friday gave a little more fuel to the fire of, okay, is a rate, is a rate cut not only imminent, but what's the size of it going to be? But at the end of the day, you want to step back from that, and if you can, take a bit of a longer-term view. And I think in that long-term view, we've continued to see a lot of robust energy in the U.S. markets and in some of these global providers, not just in technology. Technology touches everything that we do in most facets of our life, but there are other industries in play. So we're continuing to see a lot of interest in investing broadly, not only in equities, but in a lot of the flows. Some of that volatility is change-ups in fixed income.
And we're looking at how you've done this year. And this has paralleled the S&P 500 actually fairly well. Of course, you have tremendous tech representation in this. Todd, let me ask you about volatilities too. Low volatility ETFs. SPLV is the Invesco low volatility one. They invest in financials, consumer staples, telecom. You got Coca-Cola, you got Berkshire, and these things. What I find interesting is investors don't seem terribly impressed, though. I don't see big flows in consumer staples. I don't see big flows into SPLV this year. And I'm wondering, I mean, I know it's certainly rational to say flows follow prices, but when is that going to turn around? When are we going to see real flows, not just price changes?
Well, you're right. So SPLV has hit another high recently. It's actually performing almost in line with the broader S&P 500 with SPY and IVV and VU this year. But you're also right, we haven't seen the flows. SPLV and the iShares product, USMV, that's the minimum volatility ETF, have not been that popular this year. We've actually seen more money going into quality-oriented ETFs. So Invesco's SPHQ, in iShares QUAL, we've seen free cash flow ETFs, Victory Shares, VFlow, see strong demand in the month of August. So we think investors are going to sense the volatility that we've seen in September and then start to rotate in if this volatility continues September and October like it traditionally does.
What about that quality overlay, Noel? I mean, we're all traditional guys in the way we grew up listening to Fama French two-factor models. There was beta that mattered. Generally, small cap outperformed big cap over long periods. Generally, value outperformed growth over long periods. Neither of these worked very well in the last 15 years, but this quality overlay, which in my mind, big emphasis on profitability, that seems to have captured investors' imagination.
I think it has. I mean, the quality factors are pretty important, and that plays into some of our strategies. We think about a lot about quality, stability of the price. What are you getting for that? But I think the interesting thing about volatility, like the end of July and the beginning of August seems like ancient history somehow already. It wasn't that long ago, but that's what was a little bit of a wake-up call for some folks, I think, and seeing that and saying, all right, we probably need to think about, how do these allocations fit? We finally started to see some of the rate-sensitive sectors start to get a little bit of play, because people hate to say it, but you sort of forget about volatility until it's there, and then all of a sudden it becomes very front and center. But rather than just think about complete dampening of volatility, trying to think about how can you participate in the markets, maybe keep a little bit of bumpers on either side of it, but still keep this upswing because there still seems to be a lot of momentum at play.
I want to ask you about your actively managed low volatility ETF. You have a very strong exposure to tech here. Can you explain that? I mean, tech to me doesn't seem to go very well with low volatility, and yet here you do have one.
Yeah, I think the way that you want to think about the low volatility strategy that you're referencing is, again, we're trying to make sure that we are going to participate in the upside and try and cushion on the downside to some degree. So that doesn't mean that you're just going to go into deep value. It doesn't mean that you're going to avoid tech or some growth aspects of it, because you want to have growth at a reasonable price built into it.
Yeah, so here's what's interesting. We just put up the Invesco one, which of course has Berkshire, Coke, Visa, Colgate. Here's yours, low volatility ETF. Microsoft, Alphabet, Apple, Broadcom, United Health. I mean, you get my point. It's a little bit, it's different. And I know you're pointing out, no, there isn't a broad rule about low volatility, but
yeah, I think that
I don't think Microsoft low volatility. I guess that's what I'm trying to get at.
Which is fair, but I think a lot of us grew up in an era when Microsoft sometimes behaved very differently, right? And it's not that this is like some company that doesn't have this great potential to it, or still isn't so impactful in our world. But again, it's a really big company with a lot of different aspects. All I can tell you is you're getting flows into this low volatility ETF.
The traditional low vol SPLV is not really getting big inflows this year. So whatever you're doing, if flows is what matters, you're certainly getting it. Even we could bicker about what's low volatility and what's not. Todd, low volatility, high volatility, it doesn't seem to matter in terms of flows. I'm looking at year to date, where we are, ETF assets, flows into equity, flows into fixed income, non-traditional is getting some inflows, active is getting some more inflows. It's really remarkable. It's really kind of incredible. Like low volatility, high volatility, you're still getting inflows no matter what happens, essentially.
Yeah, I mean, well, there's investors that are buying ETFs for strategic reasons, and Vanguard 500 ETF already has set a record for the calendar year, and we have 4 months to go in terms of its overall net inflows this year. But we are starting to see some of the other sectors participate from a flow standpoint, real estate being one of them. We've seen real estate XLRE, which is a real estate select sector spider ETF, VNQ, which is the Vanguard real estate ETF. Those saw net inflows thus far, or in the past month. So we are seeing some of those more defensive sectors that are performing relatively well since the beginning of the third quarter start to see investor
So
demand.
this gets to that question of, does flows follow prices? Because we've seen interest rate sensitive sectors, utilities and real estate, for example, outperform recently, which makes some sense. And I know inflows like in real estate have improved a little bit. But assets under management are still pretty modest in some of these smaller sectors, essentially. Will they see inflows? Will we start seeing more significant inflows as investors take profits in tech and maybe broaden out into other sectors?
I think it's more likely that if we see a sell-off, that those defensive sector ETFs get bid up, as opposed to people using them to outperform, but more to reduce the risk profile. We've also seen the more risk mitigating strategies, the defined outcome products, the ones that have structured protection, Calamos, Innovator ETFs. You guys have those products as well that have come. That's starting to gain traction, and people are not going and building their own sector defensive strategies the way they might have beforehand.
Yeah. I want to move on to bonds and talk a little bit. We've seen bond ETFs, great inflows this year as well. We just put up a screen about that. You have an active high yield fund that's seen inflows. Prices have held up. To me, this is quite amazing. It would seem this is a good sign, because if there was an imminent turndown, folks, high yield would sell off, right? I mean, it's credit, and it's risky credit.
Well, I think that the health of the credit markets is in some of the best shape that it's been. When you think about the last few years and where we've seen the move by a lot of companies and how they're treating their books from a credit perspective, the yield that you're getting off this is still really attractive. The yield to worst in the high yield space is usually highly predictive of where the credit markets are going to go in the 3 to 5 years in front of it. So I think what we're seeing is a continued interest in the health of high yield and what that can look like in a portfolio as investors start to think about how to redeploy some of this cash that has frankly been sitting on the sidelines for quite some time now.
It's amazing to me how much the viewers, investors in general, love their short term. You have a short term one too. even though yields are coming down, we still see inflows into your ultra short income ETFs. They love these 5% yields, but they're coming down. Even as they're coming down, it's remarkably sticky. Money market funds are holding up $6 trillion very well. They seem comfortable even at a lower level.
Well, I think what we see...
There's a behavioral psychology thing going on here. They still perceive there's a positive inflation-adjusted yield there.
Well, there's still, I think, a view, too, in the ultra-short space that is a...
And here's your ultra-short.
Increasingly, a better play than money markets, because when rates do decline, they tend to go very quickly in the money market space. They'll decline faster than you'll see in general in that ultra-short income space. So for those that want to stretch out their duration a little bit, who might not be convinced of completely which way the market's going to go, that ultra-short leg has been, I think, a good transition phase, and that's what we're seeing. We're seeing either people go into the ultra-short, or they're just going out to long duration and just saying, okay, I'm going to try to there.
You're still over 5% on this ultra-short here, right?
I believe so.
Yeah, I think it's 5.5, as I recall, somewhere around there.
I mean
it's really remarkable.
It is, and I think what we're the conversations we're having. I don't know how much you're hearing about this, Todd. Is also this a little bit balanced is back, right? Which we haven't had that in a lot of years either. This thought that I really do need to look at both sides of that equation. I mean, people have been so focused on what's going on with rates and when are rates going to fall and what should I do in the fixed income portfolio and should I move out of cash now or later. Meanwhile, there's been 25% run in the last 12 months on the equity side of the books, and folks that sort of took that balanced approach have been in a pretty good place over that time period as well.
And we've seen the benefits, what they offer is an actively managed ultra-short bond ETF. So we've seen investors been embracing active strategies like Year, which Noel's team has, firms like products like Mint from PIMCO, JPST from JP Morgan, these ultra-short active fixed income ETFs that can go outside of treasuries to be able to find the best reward for that.
Well, explain that a little more. By the way, ultra-short is what, 30 days? What are we talking about mostly?
It's 1 year or less, right?
1 year or less.
They'll flex. The products will flex anywhere from 6 months.
Right, and when
they
can go outside of treasuries, what percentage would this have, for example, in a outside of traditional?
Again, it's going to vary by time period. We're very focused on our particular product on the liquidity piece, because you want to make sure that in sort of periods of volatility or steadiness, whatever it is, that the liquidity is there in an ultra short product. So things like securitized might only be 5% of our portfolio. There's going to be treasury repos. There's going to be a little bit of money market exposure there as well. So there's always going to be a blend just based on what's going on within the course of that year. And we'll dial duration up. Again, you might have a few pieces in there that'll go over, but on average, you're going to be at that 1 year or less. We'll go as short sometimes as down to 6-7 months duration, or we toe the line right up to a year.
So it's actively managed. It's not a money market fund where you're almost entirely. I mean, if it's a government money market, by definition, you're entirely
right. But it's also not built like the State Street product that's just treasury oriented. The benefits of active management is they can find where that best reward opportunity is from a liquidity standpoint. Own corporates, own CP. Which is a great addition for investors and advisors.
Yeah, and for us, the focus is we run a lot of income products across the suite of fixed income products at AB. So the same team that runs our income portfolios is running that ultra short income portfolio. So they're looking at that whole market and then trying to put their best thinking into that ultra short space to make sure we get that intersection of yield and liquidity.
Yeah, we just put up some charts of your Core Plus bond fund, which is, I gather is broad bond fund, treasuries, corporates, some high yield as well, right?
Yeah, correct.
Yeah, and corporate bond ETF as well, the EYEG. What kind of flows are we seeing here? Yeah, my impression is overall that it's still very good.
They are. These are newer funds, so they are. I'm trying to recall when we launched those products towards the end of last year. So these are still relatively new in the marketplace, but we're starting to see a lot of queries on this front, and this goes back to that. The ETF market's 30 years old now, and we have a lot of passive products in the marketplace, but so many of our conversations are, how can I take some of this active management? And you and I talked about this a little bit earlier, that the active funds today aren't the active funds of yesterday. Yeah. And so we're getting a lot of, how do we pair these together in model portfolios across fixed income strategies?
Yeah. So Todd, we have a record August for bond inflows. I had Matt Bartolini on from State Street last week talking about this. Our investors, riff on what Noel was just saying, our investors distinguishing between short-term or long-term or treasuries versus corporate versus high yield. Look at these, 33 billion in August, a record for August. 190 billion, this is bond ETFs, not stocks. And the last time we had a record was 212 billion in 2021. Look, we're going to break the record here.
We're going to break it in September, quite possibly, because of investor adoption of ETFs. They like the liquidity, they like the accessibility, they like how easy it is to put these products into use. So to your question, TLT saw really strong demand. That's the 20-year Treasury ETF from iShares. It saw really strong demand in August as investors expected that the Fed was going to begin cutting rates and they could get rewarded for that. We did see some interest in the ultra short categories that we were talking about. We saw high yield demand. USHY, which is that iShares ETF, is now the largest. It eclipsed HYG in terms of the overall flows that we're showing here on the screen. And I just want to come back to active management within fixed income. It's fully being embraced as firms like Knowles, firms like Capital Group and T. Rowe Price and Fidelity bring their best managers into the ETF space. And we're seeing a lot of success from these firms that are either they've converted and now they're here to stay in the ETF marketplace, or they've launched those products and they're benefiting from the ETF ecosystem.
Noel, you've been around a long time. Where else do you see? Obviously, active management is a major part of things. Some of this is not your grandfather's active management. A lot of this, of course, is different than active stock picking. But what other growth areas do you see in the ETF business?
Yeah, well, I think what's fascinating is it's not only about the ETF, right? We're seeing so many different changes in the ecosystem around investing. So the active stuff is I think, really positive. 30% of flows is here into active ETFs. So I think, and that builds on where we were last year. So such a good blend going on there. SMAs are another growth story in the marketplace. And again, it's always like these sort of unsung...
SMAs being separately managed accounts. Yeah, just want to make sure the viewers understand all that.
And then you've got...
So you people who have separately managed, these are funds that are managed for individuals or funds or companies themselves, and they convert them into an ETF.
They can. I mean, that's one arena. I think the mutual fund to ETF conversion is another piece of this. But I think, again, the unsung hero of the ETF is its operational flexibility, and using ETFs within the growth of the separately managed account space within unified managed accounts. So these are accounts that can hold mutual funds, SMAs, ETFs, all in one package. 25% of the accounts in the US today are UMA accounts, meaning you can hold anything within it. And investors are getting really savvy about how can I take the tax benefits of an SMA, marry it with the tax benefits of an ETF, take my low cost beta, park it next to my active ETF that might have, again, some tight combination of qualitative and quantitative factors, and build optimal portfolios.
Boom, you've got a diversified portfolio.
It's pretty nice. It's a great time to be an investor.
It's a great time to have ETFs. It's so much fun. I've been covering ETFs, I'm trying to remember when, it's somewhere around the late 1990s, and to watch them grow up like this is just wonderful, because not only are largely they're indexed and diversified, which is the old Bogle guy, that's my big thing, diversification, but low cost. And that was Bogle's other thing. Bogle was never against active management. He was against high-priced active management. So here, even with active management, you generally have pressures to keep the fees down, which is what makes it successful.
Yeah, it's highly competitive. I think what you're paying for the active ETF in the marketplace, again, you can have a combined portfolio of active and passive and have a pretty low basis point average weighted portfolio and get the benefits of both views in there.
Going to have to leave it there, folks. Two of the best in the business. That's what we bring you. That does it for this week's ETF Edge. My thanks to Noel and Todd. We've asked Todd to stick around and provide us with more insight on ETF flows for the rest of the year. That's coming up on our ETF Edge podcast. And remember, you can see all of our shows. It's on our website, folks, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.